Welcome to the video of how to make 30% a month trading the news. In this video, we're going to learn how to contrarian trade the news that go against public overreaction to make money on bounce backing and options. As demonstrated in the previous video, the majority of the public tends to overreact. So what do we mean by bounce backing and options? We're going to be looking through the most up list for the day and the most down list for the day, because that is just basically stocks that have been greatly reacted on. It's the most up list for the day and the most down list for the day. So now what we need to do is go through these lists and find out on these stocks that are big reactions, which are overreactions to the upside or overreactions to the bottom side. Now we have our list, the up list and the most down list, which are basically extreme reactions in either way. Now once we go through this list and we find the overreactions, either to the upside or the downside, these are going to be the stocks that are going to bounce back to the correct valuation quickly within a day or two. So we're going to take options out on these stocks, whether it be call options or put options, depending on the direction we want the stock to bounce back to. And the stock's going to bounce back, and we're going to make a quick anywhere between 30% and 100% over the course of a day or two. Now the question is, well, which list of the day do we use? Do we use the gainers list, the most up list for the day, or the losers list, the most down list for the day? And the answer to that depends on which way we think the stock market is going to go over the course of the next few days. When the stock market has a good day, you'll see a lot of the stocks like blue chips and a lot of other stocks will tend to go up as well. The stock market will bring them all up. When the stock market tends to have a bad day, a lot of the blue chip stocks and a lot of other stocks will be dragged down with it. It's kind of like the waters on a beach. When you have waves come in on the beach, they come in and then they go back out. Now imagine stocks, blue chips, small stocks, whatever, as beach balls sitting on top of that water. They get dragged in with the wave, and they also get dragged out with the wave. Now grant you, they can have a good day or a bad day independent of that wave, but they're fighting the whole forces of the market. So the beach ball could slightly go the wrong way of the wave, but chances are it's not going to. The wave's going to bring it in, and the wave's going to bring it out, independent of what kind of day the stock is having. Now, there has been cases where a stock is up on a down day, but that's kind of rare. As a whole, stocks tend to go with the direction of the wave coming in on the beach on the sand. They brings the ball in, brings the ball out. Now, this is very important. Here's the concept. So stocks tend to ride like beach balls on the water of the stock market. So now, if we think through technical analysis that the stock market is going to go up over the course of the next couple of days, we want to be using stocks on the most losers list, the most down list, and here's why. When we go through the most down list, we're looking for stocks that have been an overreaction to the downside, an emotional overreaction where we think the stock is going to bounce back to its correct valuation, bounce back up to the upside. Okay, it's the most down list. Any overreactions on that down list is going to bounce back up to its correct valuation. So this stock's going to bounce back up to its correct valuation, helped by the fact that we think the stock market is going to go up over the next few days, as we found through our technical analysis. So this beach ball, this stock, is not only going to bounce back from its own thing because it's been overreacted and it's going to bounce back to its correct valuation, but it will also ride the waters of the stock market up, because we think that this water is going to be flowing up as a whole in the stock market. So not only is it going to be bouncing back from its own volition, but it's also going to be taking a ride on that water going up as well. It's like a double effect. Now, if you think the stock market is going to drop over the course of the next couple of days through your technical analysis, then you want to look at the most gainers list for the day, the most up list for the day. So all these stocks on the most gainers list, as well as the most down list for the day, are big reacted stocks. They're a big reaction to one side, either to the up or to the bottom. We're going to go through this gainers list and we're going to look for emotional overreacted stocks. Stocks that shouldn't have gone that high, that are too overbought because people have just emotionally overreacted to the news. It doesn't affect their core business. It's just an emotional overreaction. We decided these stocks are going to drop over the next day or two. This, coupled with the fact that the market is going to be going down in the next couple of days based on our technical analysis, these stocks are going to be like beach balls that are going to ride the wave of the market going down the way we want it to, down, because these stocks are totally overbought. They're emotional overreactions. We know based on their own, they're going to bounce back to their correct valuation downwards over the next day or two. It's going to be helped with the market also going down. So again, it's like a double action. It's like the beach ball on the wave, both going in the direction you want it to. So to recap, when you think the market's going to be going down over the course of the next couple of days, you want to use the most gainers list. When you think the market's going to be going up for the next couple of days, you want to use the biggest losers list, okay? And the reason for this is because you always want the market to be going in the direction you want your bounce back to be going in. You never want to be fighting the waters of the market. You never want to be that beach ball that needs to go the opposite direction of the wave. Use the market underneath you to go the direction you want it to go. Now you may be asking, well, how do I do technical analysis on the market? Now, while this isn't a primer on how to do technical analysis, I will give you some basics here of what I look at. I like to use a site called stockcharts.com, okay? That's a great technical analysis site. I've been using it for about 10 years or so. Now, if you want to look at the market as a whole, I just look at the NASDAQ. That basically gives me a snapshot of the market. And the way you do that is by typing in the symbol QQQ, okay? That basically mirrors the NASDAQ. So I'm sitting here looking at this, and I see, which way I think the market's going to be going based on the RSI, okay? That's the line on top. And then the MACD, which is an indicator on the bottom. Now, that's a lagging indicator. Now, just look at it, you know what I mean? Just go through it and see what happens when, usually when there's a tail on the bottom, it's going to go up on these individual candlesticks, which are each day of trading. When there's a big tail on top, it tends to go down. The shadow candles are red, the white candles are white, and we're looking at, and just basically by looking at it, the RSI is getting above the midline. Now, I think it's going to dip a little bit and then start to climb. Now, look at the MACD. That's in the bottom position. It's probably going to climb, okay? I think the market's going to dip over the course of a day or two or three, and then I think it's going to start climbing based on what I'm seeing, in the channels and everything. So I think the stock market's going to dip for about 2 or 3 days, and it's going to continue to pull up. And so right now, if I was going to be doing a bounce list, I'd be looking for this thing to drop, okay? So I'd be looking at the most gainers list over the next 2 days. After that, based from what I'm seeing, I think the market's going to start to rise. So at 2 days from now, I'd start to look at the most losers list and be doing bounce plays off that. Okay, let's go with an example of me going through the QQQ technical charts, and we'll start on December 9th, so we can't see what's going to happen afterwards, and we're just going to go through it day by day, and I'll just show you what I'm looking for. Now, first of all, you see that the stock tends to follow this channel right here, all the way up. It wants to stay above the channel, bouncing up and down. Now, you can see that the RSI up here is in the bought territory. It's near the top, and the MACD is kind of near the top too. But anyway, the most important thing is the candlesticks. Each day is one candlestick as it goes day, upwards and so forth. Now you can see that as it's going up, it's petering out because the candles don't have much body. They're kind of flattening out, and they tend to do that at the top or the bottom. So it looks like it's at the top here because the candles are dark. When it's white, that's upward pressure, and when it's dark. And then all of a sudden, we're thinking it's going to drop. So the next day it does. It's a dark candle, and it's a big long candle, and there's some dropping, and it drops and it keeps going. The RSI is going down a little bit. Now you're looking here, and the candles are showing some pressure to the downside. They're still showing they're trying to go up, but they can't, so they have a body on top, which means it's probably it's going to tend to keep on going down. Okay? When they have a tail on the bottom, that means there's pressure to the upside. When there's a long tail on top, there's pressure to the downside. Now it keeps doing it. Now all of a sudden you have this candle. Okay? You have a big white candle which overshadows the other candles before it, which were dark. It's longer, and it has a big tail on the bottom, which signals reversal. The long tail, again, right here you can see is pressure upwards. So at this point, we would be looking at the cubes and thinking, okay, we want to do our most down list, our most crush list, okay? Because now we think the market's going to go up, and we want to bounce with pressure to the upward side because we think the market's going to go up. And so now let's see what happens over the next few days. There we go. It's going up. It's going up. Now you can see again, the bodies of the candles are starting to flatten out here, okay? And now you're starting to see some dark, and it's coming up towards the top. And now we think at this point that the market is probably going to start dropping again, okay? The candles are flattening out and they're turning dark. And so right now I would bet that the cubes are going to go down. All right. It's got some chop. It's got some upward pressure because there's a lower tail. However, it's still a dark candle. I would still stay down at this point. All right, a bigger dark candle. Okay. Now you get to this point right here, and at this point I really wouldn't know what's going to happen. As you can see, the RSI tends to be bouncing in the middle, and now it's towards the middle again. It's not going through the middle line. And so that would probably tell me that it's probably going to go up a bit, but I'm not too sure. This candle isn't too obvious what's happening. But then again, we look at the channel here. And it wants to stay within the channel. So I would say that keep on going. So probably the next couple of days it would go up a little bit. That's my guess. Okay, there you go. There's a white candle. All right, it's probably going to go up a few days from here. And we're moving all of a sudden up. There's a dark candle. Okay. Doesn't have much of a tail underneath it. The MACD, now in reference down here, it looks like it's on a downward trend. And so at this point, I would probably say down. Okay. So then you have that, and that's a failed spike to the top. It wants to go up, but the candle's flat on top. And when you ever see a cross candle without much body, it looks like a cross. That means it tried to go up, but it couldn't really, and it just petered out. It's probably going to go down. There's a dark candle. I would have to say down from this point, based on the information I see. Up, white candle overshadowing it, the candle in front of it, of a different color. That means it's going to go the direction of that second larger candle next to it. So at this point, I'm going to say up. And again, see this channel that it's following. It doesn't really want to go down much further past this, and so it's going to probably want to go up at this point. All right, there you go. You get a little gap up. And then once again, it looks like it's starting to chop at the top. The candle's getting smaller. And you just look at its pattern from the previous climb. You know what I mean? And you look at what happens at the top, they flatten out, and at the bottom, they flatten out. Looks like it's flattening out again. Okay? Upward pressure a little bit, but still a dark candle. Upward pressure, but not too much is happening. All right? We probably say still up at this point, and then, you know, it's still flattening out. And all of a sudden, here's a cross. Okay? One of those crosses again with no body, even though there's a long tail on the bottom, that cross is probably signifying a drop. So at this point, I would start saying down. Okay, I would start guessing the QQQ is going to go down. So even though I said there's a tail on the bottom that shows up, but since there's no body and it looks like a cross, whenever you see a cross, it usually means down. So now let's see what we start betting that it's going to go down. Oh, boom, big down day. Big dark candle. It's going to keep going down. All right. Looks like you might be looking for a bottom. There's a little bit of a tail on there, but we're still gonna bet down. Now, even though there's a white candle here, it's not overshadowing the dark candle in front of it. So we would still bet down at this point. Okay, and if you look at the MACD, it's in a strong down position. And the RSI, look, it just broke through the middle. Okay, it broke its resistance point in the middle. So we're still gonna say down at this point. And a big problem is it broke through the resistance line. It's moving day average, and that's not good. All right, so we're going to still say down. All right, and then you got one of these. There's a bit of pressure to the upside, but we're going to see if that keeps going. We're just going to still bet down. All right, and we're wrong. Okay, there's a slight jump up. Okay, I'm still seeing some chop here. I'm not sure what's going to be happening. At this point, I'd still bet down. Okay, candle next to it, things are dropping. You broke the resistance. Because this resistance is broken, I'm not sure what's going to happen yet. I'm still not getting a strong signal up. I'm still not getting like a tail on the bottom. So let's move it over one more time. Big dark candle. Okay, that's a problem. So I'm still guessing down at this point. I'm not getting a signal saying climb yet. Okay, and now we're getting, things are flattening out. Things are flattening out, and there's that cross again. That's a problem. Let's move to the next one. Okay. Now we have a jump up. At this point, RSI is starting to climb. This looks like it's starting to bottom out down here, the MACD. At this point, you know, this candle overshadows that. I'm going to say up. I would have to guess up. There we go. Jump up. Big white candle. Still in an up position. Up position. Still in an up position. Climbing up. All right, things are starting to flatten out. There's a cross. At this point, I'm still going to say up. There's an up. All right, so that's how this goes. Okay, so you just keep going one candle at a time, and you just get to become a QQQ expert. Look at the chart, see what it's done. Just do what I've been doing in practice, and have a sheet and write down what does what. And after a while, you're going to be able to read this chart with 80 to 85 to 90% accuracy, and you're going to be able to determine which way the market's going to go with about 80 to 90% accuracy over the course of the next couple days, and that will greatly aid you when you're picking these stocks based on news, because you want the market to go the opposite way of the news list, up or down list that you pick, as I described earlier. Okay, now we've decided which way the market's going to go over the course of the next couple days, and we picked a corresponding list, the most gainers list or the most losers list, and we're going to go through these lists now, and we're going to go through them one by one, and we're going to do some eliminations. Now, we're going to look at all these stocks, and we're going to look at the news and look at their company events, and we're going to eliminate stocks that are just about or just have done in the last 2 weeks any mergers. So they're out. Number two, any stocks that are on the list because they just announced earnings today are off the list. And then look back, if they've announced earnings in the last 2 weeks, they're also gone. Okay, we don't want things moving around because of earnings. Earnings are solid, either to the upside or downside, and they usually mean what the stock's core performance, and we don't want that. Okay, number three, any analyst upgrades or downgrades. We will not consider the stock if they've had one of those today or in the last 2 weeks. Number four, if a stock has moved today and you look at the headline news and there's no reason for it, you can't find anything in the news. Maybe the last thing was a couple days ago and just today it jumped or dropped and there's no reason today. That usually means there's some sort of insider information happening and you are not privy to that news, so you don't want to play with it. You don't know why it moved, and something big could be coming up that can affect its core performance, and you don't want to touch that. So if there's no reason today, then you don't touch it. Number five, stocks that have just been purchased at a certain share price. So, for example, you have stock B that was just purchased by stock A for, say, $42 a share, and you're going to see that the stock price is most likely right at $42 a share. All right, you don't want to play with those either. So those 5 reasons, don't touch it. Now, the stocks that are left, you want to go through them again. Now, number one, those stocks that have no options, okay, if they're not optionable, strike them. We're only playing with options here. Number two, if they have a volume under 30,000, you don't want to play with those because they start acting weird. You want volume over 30,000 only, okay? Number three, you don't want to play with stocks that have they're thinly optioned with thin strike prices. Maybe just 2 strike prices, and they're not near the current stock price. We don't like that. The more strike prices, the better. The more compact the strike prices are, like every dollar, every $2, the better. We don't want thin strike prices. We don't want one out there and one kind of close, because basically we want to be picking at the money or slightly outside the money, either way, to either side. So we want a lot of strike options in our prices. If it's very thin or weirdly spaced options and they don't have much volume, don't consider it. Okay. Number four, stocks returning to parity after a previous event. So what you want to do is you want to look at the 5-day history in the past for the stock. And if you see that it's coming back down to its previous position from a big current event, that could be why it's on the most up or most down list for the day, because it's returning to parity. You want the last 5 days that stock to be kind of flat or doing its consistent thing, and you want this to be a new event, a new rise, a new fall, not a return to normal from a previous big rise or fall, okay? If there's been a previous rise or fall event in the last 5 days, scratch it off the list. Okay, now that we've gone through those eliminations, we're going to be going down the list and looking for news that we believe is overreactions. Either that the stock is overbought or oversold, depending on if we're on the most gainers or the most down list. So let's go through it. So here's one example. Say stock ABC announces that they got a new contract to supply scanners to UPS to speed up UPS package scanning times for their delivery service. Okay. Now, do we want to bounce stock ABC? Okay. No. This is huge. UPS is huge. This will significantly affect ABC's bottom line. Stock will continue to climb. You can't bounce this. I mean, UPS is gigantic. That's going to greatly help UPS, and they're going to buy a lot of scanners. Stock ABC is going to make a lot of money. This is something that affects their core business. You don't want to use that. Okay? All right. So here's another example. Stock ABC announces that stock ZTZ just bought 2.1%. Just bought a 2.1% stake in their stock. Okay. On the surface, that sounds like a big deal. However, stock ZTZ says this is just a share price, just a common price. ZTZ has no plans of changing anything, and it's just there as an investment. It's just going to be there silently along for the ride because they thought that ABC is just a good company. So now the stock's up 16%. Okay, so now you're looking at this. All this was a show of faith. ZTZ is just looking around to invest. They don't want to do nothing. Okay, so the This is an overreaction, 16% up, okay? ABC does not deserve to jump 16% just because some ZTZ, some other stock just got on board for 2.1%. They're not going to change anything that's only 2.1%. They're not going to change how the company works. They just want to ride along on the coattails, which means nothing changed in ABC's core business, okay? And it's not enough of a significant stake to jump in to cause it to rise 16%. Therefore, this is an overreaction. So you would buy puts betting that it's going to go down on the next day or two, okay? So people just piled on. They thought, no, this is a big deal, but it doesn't change anything in ABC's core business. Too small of a stake, and they just want to ride along the coattails. They were just looking around to throw some money around to invest, okay? So the stock price is going to drop when people get their heads together in a day or two. All right, here's another example. Sector scares or sector jumps are great opportunities. So here's an example. WWA Airlines, a big airline in the industry, warns of large losses coming up, citing specific internal problems, not based on the industry, but their own airline. And they may have just announced earnings and had a bad announcement. In corresponding news, AAO Airlines and BZD and OPP Airlines are also down for the day. All right, that's good. That's a sector scare. That's an emotional overreaction. People assume that the other airlines are going to have a problem too just because one of them announced something bad. Now you look at the reason why the first airlines, WWA, announced something bad. Was it something to do with the industry, or was it something to do with their internal processes just on that airline alone? If that is the case, and it's just that one particular airline, then that's an emotional overreaction with those other airlines selling off. That's a sector scare, okay? You want to not, WWA, you want to avoid that one because they just announced that would violate our list. They just announced earnings or, really bad core business news, something that affects their core business. But then you want to check out the other airlines that also dropped, AAO, BZD, OPP. Unless they also have specific news, they are just being emotionally sold off by investors because WWA is such a big airline. It's a sector scare. And with people incorrectly linking WWA with the other airlines out of fear, okay? That's an emotional overreaction. So you want to go ahead and bounce those other airlines if they don't have any news to the upside. So there's another example. Basically, you don't want news to affect the core making money processes of a stock. You do want news such as sector scares, optimism, or lack of optimism based on no core money making processes of the stock. Now, the less sure you are, the more you want the option strike price to be right at the money or the money the stock is currently at. The more sure you are, you can wander out just a little bit and get an option more out of the money, okay? Because you'll make more of a return after the bounce happens, but not so far out. And when I go through specific examples, I'll show you what I'm talking about. But once again, if you're not too sure, you want to write at the strike price. And if you are kind of sure or really sure, you can go out a little bit and go out of the money. But again, I will cover that more in detail. Okay, more examples. Pharmaceutical companies are great companies to short or buy puts on. We buy puts. And here's why. They come out with news saying stage 1 or stage 2 trials are a success, and especially if that's the only drug they really got going, investors tend to jump on it. Now, the problem with that is pharmaceutical companies, when they're going through the approval process with the FDA, it takes them 4 stages and then an initial 5th stage review. Chances are they're not getting past the 3rd stage. A lot of companies try it, they pass the 1st and 2nd, and then the FDA starts finding problems with their 3rd and 4th stages. And then all of a sudden it's back to formula, back to the drawing board. So whenever they have an announcement saying phase 1, phase 2, a great success, and the stock jumps, it's an emotional overreaction. Chances are they're not going to get through the rest of the process, the approval process, and investors know that and come to their senses like 1 or 2 days later. So today it says, for example, today pharmaceutical company ACW announces that phase 1 trials are a success, and ACW is developing an anti-leukemia drug that's showing great promise. The company officials say blah, 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 blah. Okay, stock's up 22% today on the phase 1 completion announcement. All right, this is good. Phase 1 or 2 trials, again, don't mean much of anything. Usually the pharmaceutical company that doesn't have much going on, investors get really enthusiastic because they've been waiting for something like this, and they jump on it. And 1 or 2 days later, people realize, well, they still got phase 3 or 4 to go through, and then it usually drops. So these are gimmies. These are pretty easy plays. I like those. Here's another good one that has a fake out. You really have to read into this. So Plug Power today, it's up 38% today. Spiked after the CEO said they're announcing a major deal with a global automaker in 2 to 3 weeks. So the stock's up 38% today, and then two other companies are also up. Okay, Fuel Cell and Ballard Power Systems. They're both up 30 and 30% respectively. So you look at Plug, and that's bad. Okay, Plug Power is announcing something that's going to affect their core business. Okay, they have a major deal with a global automaker, which is going to use their products, which means they're going to make a lot of money, and their stock price is going to go up. So then you're thinking, good, well, it looks like we've got a sector play opportunity here. You know, the other two are going up. I don't see any news on them. They're just going up because it's an emotional reaction that the sector's going up. Then you look at the other two, and you look at the 5-day history, and then it turns out to be bad. The entire sector is returning to parity after a big drop 4 days ago, so we can't use it. So, you know, they're returning to parity, and there's a sudden jump, but it was because of an earlier news event from the entire sector. So we went back 5 days, and we saw it was recovering from a previous event, so now we can't use that. So there's that example. So what I'm going to do underneath this video, as I go through these and add more and more examples, I'm going to keep putting them on the link right underneath this video of the examples. So this list will continue to grow, and so you can refer to this list when you're trying to figure out how to play the news lists. You know what I mean? How to play the information that you find in the stocks. And I'm going to go through my decision-making process example by example, and as I keep going, this list is going to keep growing, so you have a wider database which to pull from as the weeks go by. So you could just, you know, scroll over these examples and see my line of reasoning as I'm picking through them. And I'll just continue to add to this list. So that'll be in the link right underneath this video. Now, I just showed you how to do it. Now you're going to watch me do it. It's 10:45 in the morning. We're going to go through the list of stocks, and we're going to find stocks that are emotional overreactions on either the most up list or the most down list. If you found this video on YouTube, to see the rest of the videos, go to this site below.